Good morning and welcome to today's webcast, West Coast State Tax Refresher. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you everyone for joining us today. I'm pleased to introduce today's presenters from Moss Adams: Anna Ferraro, Director, Sarah Correia, Senior Manager, and Colin Quill, Tax Manager. And Anna, I'll turn the line over to you to get us started.
Thank you, Emily. Today we'll be starting our discussion with California and the partial manufacturing exemption. It's actually a partial exemption for manufacturing, R&D, and electrical power generation. I will not be discussing the agricultural partial exemption during this presentation, as that seems to be an exemption most people are aware of and they are taking advantage of. We do have materials on that, so if you do have questions about that exemption, please let us know and we can send you some of the tax alerts that have been sent out a while back on that. It is common for agribusinesses to have both agricultural and manufacturing activities, so you do want to make sure that you are taking the proper exemption for the activity. The agricultural exemption is larger than the manufacturing exemption, so it is best to take a look at the activities you have and properly classify those between the 2 exemptions. So California has had the partial exemption for manufacturing and R&D since July 1st of 2014. In July 1st of 2018, or January 1st of 2018, electrical power generation was added to that partial exemption. So the partial exemptions for machinery, equipment, tools, and special purpose buildings. The partial exemption reduces the state sales and use tax rate approximately 50% from about 7.25 to 3.3125, plus any applicable district taxes. So if you're in a city or county that imposes an additional tax on top of the state rate, the partial exemption will not reduce that. That rate will still be in effect. The partial exemption is, like I said, about a 50% reduction, so it's definitely beneficial depending on the city and county you're in. And it applies to qualified property purchased by a qualified person for use in a qualified activity. The purchases are limited to $200 million of purchases per person or entity in a calendar year, and Very few people are going to hit that limit, so I don't think that's going to be a concern for most people. But if you are coming close to that, you do need to track that. Okay, so a qualified person. A qualified person can be a legal entity or an establishment. So it's key to understand it doesn't have to be the business as a whole. It can be certain aspects of the business. The following activities are defined within, and the statute points to the NAICS codes, which are the codes put out by the U.S. Census Bureau. And if you need to know the definitions and what truly classifies as something within an activity, you can go to the U.S. Government Census Bureau's website and look up the codes and see what activities are specifically within these ranges provided by the NAICS codes. So the first one is manufacturing, which is codes 3111 through 3399. So the manufacturing process begins when raw materials enter into the process, and it ends when tangible personal property has been altered to its completed form, including packaging, or at least initial packaging. So this may include the storage of raw materials if it's done at the same location as the manufacturing activity. It's usually the front end and the back end of the manufacturing activity that get a little questionable as to whether or not those qualify. So you'll need to look at those a little closer when you're going through looking at your activities. The next activity is R&D activities, and the codes for those are 541711, which is research and development in biotechnology, and 541712, research and development in physical engineering and life sciences. Effective January 1st of 2018, electrical power generation was included in this partial exemption, and those are codes 22111 through 22118 and 221122. Now, this specifically excludes the transmission of electricity, but other non-conventional parts of the electrical power generation are included in this activity. So this is the first time, the first widespread sales and use tax partial exemption that does apply to power generators. However, power generation was, even though it was just recently added to the qualified activities, people who have used solar, have installed, say, solar roofs or solar systems at their businesses that are qualified for the manufacturing R&D activities, we're still able to take advantage of this partial exemption as long as the solar was used to generate electricity for one of those qualified activities. So if you were doing something such as that, you could go back, assuming the statute was still open, to July 1st of 2014. Agricultural businesses, and we'll get into that a little closer on a later slide, but that was also a change that occurred as of January 1st, 2018. It used to be that this exemption applied to most activities in the manufacturing R&Ds, but there was a carve-out for certain types of what they called a portional business activities that had to do with companies or entities that had activities both inside and outside California. So keep in mind, I'm going to go back to this. Keep in mind that these activities, these are descriptions of activities. It is not a requirement that your entity be classified under one of these NAICS codes. And that's probably one of the biggest misconception people have is they look at their business and say, hey, I'm not classified. Does that mean I can't take it? And no, that is not the case. So although the statute states that the person's activities must be primarily in one of these codes, it does not require the business itself to be classified under one of those NAICS codes. So this exemption applies to legal entities and enterprises within a legal entity. So that means that a business that has a separate cost center, a division, or a physical location engaged in manufacturing, processing, refining, fabricating, recycling, specific R&D activities, or the electrical power generation can also qualify for the exemption. For example, a grocery store that has a butcher shop may qualify for this exemption since the activities performed in the butcher shop could meet the definition of a qualified activity. However, only the items purchased for use in that activity, the butcher shop, would qualify for the partial exemption. The grocery store wouldn't be able to take the partial exemption on purchases for its general operation of the grocery store. So as we discussed, certain apportionable trades or businesses are generally excluded as a qualified person, with the exception of the agribusiness that changed as of January 1st of 2018. So an example of an agribusiness that may not have qualified prior to this change would be a company that has multiple entities. So maybe it's an entity that has one entity that does the growing of the product, another that processes the product that is grown, and another selling the product. And the sales and use tax law points to California income tax codes in referring as to whether or not you're an excluded business. But generally, the reference is to an entity who derives 50% or more of its revenue from its agricultural activities and that does business in multiple states. Thus, an example would be a winery that has its wine growing operations in one entity and its winemaking operations in another entity. That may not have qualified if there were significant amounts of sales of grapes to third parties and those were occurring outside the state. Then it's potential that 50% or more of that combined businesses' revenue were outside of California and related to agricultural. Prior to January 1st, 2018, they may not have qualified for this partial exemption, but they do now. So what is a qualified activity? Or what does it mean to be primarily engaged in a qualified activity? And the statute gives a lot of options on this one, which is great. So, and it can get down to some not-for-profit businesses as well, because it doesn't look solely at revenue as sales. It looks at funding or grants that may be obtained by, say, a not-for-profit. So things that you can look at to determine whether or not your activity is a qualified activity, and that includes revenues derived from the specific activity, operating expenses related to the specific activity. You can look at prior year employee salary and wages, so it's the employees related to that activity, not company-wide. Prior year value of production or number of full-time employees that are engaged in the activity. So with the grocery store example, as long as 50% of the butcher shop's revenues came from selling the cut meat or 50% of the butcher shop's operating expenses were related to cutting and preparing the meat for sale, or any other of these options that are listed, the butcher shop would qualify for this partial exemption. Now, I do strongly recommend that if you're looking at a part, not necessarily the business as a whole, but a division or an operating entity, a location, that you document that you've looked at whether or not it qualifies and why it qualifies. So whether it's some notes in a file, an email, or if necessary, more detailed calculations of how you determine that you qualified, I do recommend documenting that so that if it's a questionable area down the road and you come under audit, that you can support why you believe you qualify and why you took the exemption. Okay, so the following items, when used in manufacturing, R&D, or electrical power generation, qualify for this partial exemption. So remember, primarily means used at least 50% of the time in this activity. Machinery and equipment, including component parts, contrivances, and operating structures. So this includes equipment and devices used or required to operate, control, regulate, or maintain the machinery, such as computers, special tooling. The little things are what people tend to forget about, or the peripheral stuff. As long as it's used to operate and control, it's used at least 50% of the time, it will qualify. So it also includes repair parts for the equipment. If you're having to repair your equipment and you're buying a new piece, since the equipment qualified, the repair part would qualify. Property used in pollution control that meets or exceeds state or local standards, and special purpose buildings. So special purpose buildings and foundations, this is an area that most people generally do not take advantage of the exemption, and it can produce significant savings if you're doing enough construction or enough work in that special purpose building. So to qualify as a special purpose building, the building must be used at least 66% for a qualified activity. If you meet that requirement, the whole structure would qualify for the partial exemption. If that percentage is not met, you can still claim a partial exemption on the specific areas of the building that do have the qualified activities. Thus, if your manufacturing or R&D power generation activities are, say, done in 15% of the building, then 15% of the building qualifies. And if there are special aspects of the building, say sloped floors, special ventilation needed within that qualified activity, the fixtures and materials related specifically to that would also qualify. So it's a matter of taking a look at what you're doing, what the square footage is being allocated for, and making a determination. That's definitely an area I would document just to show how you got there, unless it's such a slam dunk case that you definitely qualify. But keep in mind that sales and use tax laws for construction contractors are very different than the rest of the sales and use tax law in California. So if you are going to take the partial exemption, it will require a little bit more time and effort working with your contractor to determine what materials involved, where they're being used, getting exemption certificates not just to the prime contractor but to the subcontractors as well. So ideally, letting the contractor know during the bid process or prior to signing a contract is the best route to go, because it lets them know that they have to adjust their pricing accordingly and that they do have to do a little bit of extra work with the subcontractors. However, it is possible to go back to the contractors and obtain refunds related to some aspects of the contract. Keep in mind, going back to a contractor after the fact is more difficult, and the contractor may not be eager to do the necessary work to help you with that refund. So definitely planning and knowing in advance is definitely the way to go on this. Actually, get a couple more items related to the other part. So items that are used both in a qualified, kind of like the special purpose building. If it's used in a qualified and a non-qualified activity, the equipment could still qualify as long as at least 50% of that usage is in a qualified activity. So if you had computers that helped operate your equipment or regulate the processes, but they were also used, say, in some type of administrative purpose, as long as at least 50% or more was related to the qualified activity, you could still claim the partial exemption. Anytime you have an item, equipment or such that has that mixed usage, you do want to track the usage, at least to some extent, to be able to show that it does meet that 50% requirement, because that would be the one thing that if you were to get audited, they could contest if you didn't have documentation and it wasn't clear that the equipment was used significantly in the qualified activity. Other key requirements of the exemption is that the property must have a useful life of at least 1 year. And as previously discussed, at least 50% of qualified activity. So since it has to have a useful life of at least 1 year, consumable items do not qualify for this partial exemption. However, there is no requirement that the item has to be capitalized. This is one of the changes that the updates to the law made in 2017. It was actually retroactive back to July 1st of 2014. Most of 2014 is, for most people, is out of statute. But what was happening is the Board of Equalization, or now the CDTFA, was going in and doing audits, and they were denying this partial exemption because they said that if you weren't capitalizing an item, it didn't meet the requirements. However, this exemption applies to both the sale and lease of items, and items, lower cost items may not be capitalized due to a company's own guidelines on capitalizing versus expensing. So the legislature did go in and make this retroactive. So if you have claimed, they did put a time frame on the older stuff, but going forward, say from July 1st, 2018 forward, that it doesn't need to be capitalized. If you are to be audited and an auditor tries to assess tax on something that's not capitalized, they should not be allowed to do so. What I found on some of these audits is the auditors are they don't seem to have a full understanding of these partial exemptions, and maybe it's the ones I've encountered don't deal with this too often. I had an auditor that insisted that wineries did not qualify because they didn't see them as a manufacturing activity, and I had to explain to the auditor why the winery and the winemaking operations did qualify. So just be aware that that's out there. So qualified use. Qualified use is any stage of the manufacturing, processing, fabricating, refining, and recycling process. As I mentioned, it's the front end and the back end of the manufacturing process that get a little questionable. So when you're looking at that, the CDTFA does take the position that if you are storing raw materials on site where the manufacturing process occurs, they're going to allow the storage, the equipment used to store the raw materials as part of the exemption. But if you're storing them off site and bringing it on, they're going to deny it. The initial, as it finishes the manufacturing process, as you finish off the product and you do the packaging, that initial packaging and storage qualifies. What wouldn't qualify is if you then move all that stuff off and you open it up and repackage it to meet your customer's requirements. That may not meet the requirements of the manufacturing or can be considered part of the manufacturing process. Other qualified use includes research and development. That may get more to the side of lab equipment, but it could include computers, servers, and such. So, and even in a manufacturing operation, there are R&D activities, so you may be able to meet the exemption under a combination of both R&D and manufacturing activities. Making, producing, creating, or converting electrical power from a non-conventional power source. So non-conventional means a combined cycle, solar, hydropower, biomass. I don't think we have too many coal plants here on the West Coast, but something like that would not be non-conventional and would not qualify. Maintaining, repairing, measuring, or testing any qualified equipment. So if you're buying special equipment to test your equipment to make sure it is producing or it's operating accurately, or if you need special tooling to maintain that equipment, those types of items also qualify. Materials and fixtures furnished and installed by a construction contractor when it's related to a qualified activity. So that gets back more to the special purpose building. However, it doesn't necessarily have to be a building itself that you're creating. If you're doing some upgrades to your facilities and you need certain types of ventilation and you're putting in a special HVAC system related to that, that type of thing would qualify. Emily, we have our first polling question, and Emily will lead you through that.
All right, thank you. Our first polling question, which of the following business activities may be able to take advantage of the California partial exemption? And your options are A, winery, B, brewery, C, electric company, or D, all of the above. I'll give everyone a few moments to make a selection. To participate in our polls today, please click the button next to the answer you choose and hit submit. And let's take a look at the results. Anna, back to you.
Thank you. So most people did get it right. It is all of the above. So winery is a good example of an entity that may have a mixture of both the agricultural and the manufacturing processes. If the winery has its own vineyard and is harvesting grapes, bringing them into the facility, you're getting to the point where once the grapes are, you have an agricultural activity generally until the grapes are washed. Once you start crushing and doing other aspects, it then moves into the manufacturing. Breweries also qualify. It's basically, think of it, you're mixing a cake. Anytime you're doing something to change a product from one form to another is a manufacturing process. So breweries definitely meet that. Depending on the size of the brewery, you may have a lot of tanks and piping that would qualify. Electric companies also do qualify now as of January 1st of 2018. Sorry, I had one aspect, and I think I must have dropped the slide here. There was one aspect related to wineries and chemicals. So historically, the Board of Equalization, now the CDTFA, did hold a hard line on chemicals. And when they look at it to determine if it's exempt or not, they make a determination if a chemical is considered a catalyst or remains. And I guess this doesn't only apply to wineries, but they look at whether or not the chemical is a catalyst and is used to effectuate a change or whether it is intended to remain with the product. It was pointed out by many of the vendors to the board that their classification of chemicals related to wineries was incorrect. And it came about because there were annotations put out by the board that treated yeast one way for a winery and differently for a brewery. So the board went back with the help of various vendors and was looking at the chemicals used in the various process and has reclassified certain items as being not catalysts but considered part of the finished product. They do have on their website some more information regarding specific chemicals. So if you have any questions about that, start with the board's website and just take a look what the chemical does. So if it's part of the product, it's intended to be part of the product, it should be as exempt sale for resale. I'm now going to turn it over to Sarah, and she's going to hit on Washington.
Great, thanks, Anna. We are going to head north from California to discuss Washington's B&O tax, sales and use tax, real estate excise tax, and then review a few of the current Washington incentive programs that may be applicable to your business operations in Washington. So as most people on the call probably know, Washington does not have a state income tax, but rather an excise tax based on the gross receipts of a business. So the general rule of thumb is that all income is taxable unless a specific exemption or deduction exists. Another distinction from a state income tax is that the tax is imposed on each person, meaning that this is a separate entity state and there is no concept of a disregarded entity or elimination of intercompany transactions. So there is a limited deduction for advances or reimbursements, but certain criteria have to be met in order to take that deduction. And what we see are that intercompany transactions are often a gotcha in a DOR audit. There are about 36 different B&O tax classifications, with the most common being service, wholesaling, and retailing. An example of a service provider would be a CPA firm. Example of a wholesaler would be the sale of products to a retailer or to another person who will resell that product in their regular course of business. And then, of course, the retailer is your local grocery store or a person or business who sells the product to the consumer or an end user. In addition to the B&O tax, Washington is also one of 45 states that imposes a sales and use tax. Sales tax is generally imposed on the sale of tangible personal property and some services, unless specifically exempted by law. So as the business world changes and adapts to cloud-based services, more and more states are imposing sales tax on sales of software as a service or remote access software, downloaded software, digital type goods. So you may be wondering why I'm even talking about this on a food and agribusiness call. But the next bullet point applies to the users of such software. So if an out-of-state company is selling you software as a service or digital software to use in your business operation and they don't charge you sales tax, you're responsible for self-assessing use tax, which is due in the absence of payment of sales tax. One thing to note, since we just talked about California, this is for Washington only as far as the digital goods and software as a service type thing. California does not tax digital software or digital goods, and then Oregon, of course, doesn't have a sales tax. So another key point with regard to sales tax is that unless you have a detailed receipt or invoice or contract or other similar document that shows separately stated sales tax, under an audit, the Department of Revenue will assume that you did not pay sales tax, and they will assess you use tax or deferred sales tax. Another comment with that is that if you are audited and you don't have an invoice for a purchase, the assumption there again is that you didn't pay sales tax. So it's important to be sure to keep all of that documentation. Okay, so the next section is important in determining whether or not you need to be registered and paying taxes in Washington if you're an out-of-state business. So back in 2010, Washington began imposing economic nexus standards on businesses with apportionable income. Most commonly, those are service providers and royalties. So at that time, a service provider exceeding certain sales, payroll, or property thresholds was required to register and file excise tax returns. The intent of that change was for the state to begin bringing in dollars from out-of-state businesses, while the change in apportionment methodology and sourcing was to benefit in-state businesses. So following that change, in 2015, Washington then began imposing the same economic nexus standards on wholesalers, with the sales threshold being based on products shipped to a Washington destination. With the success of that in bringing in out-of-state dollars, in 2017, the sales threshold was applied to retailing B&O tax. So Washington certainly has not made this easy for out-of-state companies to comply with their nexus standards. There is an important distinction between the wholesaling and service side of things and retailing. So for wholesaling and service, you only need to look at those thresholds that are listed on this slide. If you have a physical presence in the state and you don't meet the property or payroll thresholds, you may not have to register. Whereas with a retailer, if you meet the sales threshold or have a physical presence, then you still would need to register. So an important thing to note as well is that these standards on this slide apply to B&O tax. So during the 2017 legislative session, Washington passed what's commonly referred to as the marketplace fairness legislation. And this affects marketplace facilitators such as Amazon or eBay and sellers on those sites, or referrers, who are often a person who receive a commission from a seller for listing or advertising that seller's services on their website, and then also remote sellers, simply a seller that does not have a physical presence in Washington but makes retail sales into Washington. So the last category here, remote sellers, is likely most applicable to the group today. Under the new legislation, remote sellers with $10,000 or more in retail sales must either collect sales tax from customers in Washington or comply with strict use tax notification requirements. We've generally seen that companies are leaning towards or have already started to collect sales tax. They'd rather do that than deal with the use tax notification requirements, which include notices on each invoice that the buyer is responsible for self-assessing use tax, annual notices to customers that meet a certain sales threshold, and then annual reports to the DOR. Additionally, failing to follow the notification requirement if a company does not collect sales tax can result in a minimum $20,000 penalty. And then additional penalties add up quickly because they're based on the number of customers that you didn't give these certain notifications to. So again, no physical presence is required under this marketplace fairness legislation. The only requirement is that you make $10,000 or more of retail sales into Washington. So one last comment on this slide. This was addressed in a prior presentation actually given by Anna last week, that last month the U.S. Supreme Court decided in South Dakota versus Wayfair that physical presence is no longer required for a state to impose a sales tax collection obligation on a remote seller. So rather, presence through sales is enough. And that decision overturned a 1992 U.S. Supreme Court case, Quill versus North Dakota, which at the time the Supreme Court had ruled that a state cannot impose sales tax collection obligations on a remote seller unless that seller had some sort of physical presence in the state. So that recent decision affects remote sellers making retail sales across the U.S., and it's likely that you'll see more and more states begin to enforce economic nexus standards for sales tax, similar to Washington's, although I will say that Washington's standard of $10,000 is very aggressive, and I think the only way right now they're getting away with that, so to speak, is that they have that option of the use tax notification. In South Dakota versus Wayfair, the threshold was either $100,000 of sales or 200 transactions in the state. Okay, so now that we all have a complete understanding of Washington taxes, let's talk about what's not subject to B&O tax for food, beverage, and agribusinesses. I'm going to caveat this that we're looking at this from about 30,000 feet, so if I don't mention a unique exemption or that something is taxable, it doesn't mean that it's not. It's just that it's not covered in the slides today. So as I pointed out in an earlier slide, an assumption should be made that all income is subject to B&O tax unless an exemption exists. So here we have a few of the exemptions granted to your industries. The first is the most common exemption, which is that wholesale sales of agricultural products sold by the grower of such product are not subject to B&O tax. So the last part of that is important to note. If you bought the product from the grower and you are reselling it unless there's a different unique exemption, you're generally going to be subject to B&O tax because you're selling a product that you didn't grow. So there's also a general exemption for fees received from the washing, receiving, sorting, and packing of horticultural products. Again, that has to be done for the grower of the product. There is currently an exemption for processing of fresh fruit, vegetables, seafood, and dairy. However, this exemption only applies to the manufacturing B&O tax. So manufacturers in Washington are subject to manufacturing B&O tax on 100% of their product that they manufacture in Washington. This exemption eliminates the manufacturing tax, but it doesn't eliminate the retailing or wholesaling B&O tax on the sale of the manufactured product. So at the end of the day, what this exemption does is it benefits companies who manufacture in Washington but sell their product out of state, because now you don't have to pay that manufacturing tax on what was manufactured in Washington. Additionally, there are some exemptions provided for transactions between related parties, which would include contract labor and farm management services. Again, you have to be related under IRC 267B. And then there's some custom farming operation exemptions, and those operations have to be performed by a farmer for a farmer. And then the activity has to be directly related to the growing, raising, or producing of agricultural product. And the farming operation must be performed by an operator using farm machinery, equipment, or a farm implement. So while those exemptions sound great on their face, they are limited. So here's some common taxable transactions for B&O tax, and this is where we see clients get hit in audits. So hauling for hire, it's subject to a public utility tax if it's done for unrelated parties. And the public utility tax rates, there's two different rates. They depend on the distance of the haul, but most of it is taxed at the higher 1.9%. Additionally, custom packing charges, which would be charges for someone other than the grower of the product, are subject to B&O tax. Commissions from the sale of product fall under a taxable sale. However, there's an opportunity to reduce your Washington liability by looking at the destination of the product that you're receiving the commission for. Additionally, storage and warehouse fees are generally subject to tax under the warehousing classification. One thing to note is that the rental of real estate is exempt from B&O tax. So if the income is received from the rental of a storage facility rather than a per bin or per box charge, then an exemption may apply there. And then again, as we discussed earlier, Washington being a separate entity state, there's really no concept of pass-through income or disregarded entities. The dollar amounts in B&O tax associated with intercompany transactions can add up quickly in an audit, and a few common transactions that we see that are taxable would be an allocation of overhead charges between entities, payroll reimbursements, and other management fees. Okay, Melissa, we're at our next polling question.
All right, our second question is true or false? Farmers are not subject to B&O tax in Washington. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And this is our second question for today. Give everyone a few more moments. And let's take a look at the results. Sarah, back to you.
All right, so the answer on here is false. A lot of times I hear people say, well, I'm just a farmer, I'm not subject to B&O tax. But depending on other activities that you do, you may be subject to B&O tax. So if you're a farmer and you're hauling for your neighbor down the road, you certainly could be subject to the motor transportation tax there. Okay, so moving on to retail sales tax and some common taxable purchases here. We have farm machinery and equipment, farm supplies, so other farm tools or trellis or protective netting, general office supplies that you may use in your farm office or building location, cleaning supplies and materials, and then farm vehicles. So some common exemptions that relate to the planting and harvesting side of things would be seedlings, fertilizers, chemicals, feed, packing materials used, and then the big one would be the farm replacement parts for machinery and equipment. So something to note, so the original purchase of the machinery and equipment used in the farming operation is generally subject to tax. If you are repairing or replacing an existing part, then you may be eligible for the exemption there, and that would include any labor charges. But you have to be repairing or replacing an existing part. You can't be adding something onto a piece of equipment to qualify for that exemption. On the processing and manufacturing side of the operation, there's the general manufacturing M&E exemption. Under that, you have certain criteria that have to be met where the machinery and equipment has to be used directly in a manufacturing operation. So the easiest thing to think of there is it has to act or interact upon the product that you're manufacturing. It has to have a useful life of more than a year. Handheld tools don't qualify, although if it's a handheld power tool, it may qualify for the exemption. And then repairs, including labor to qualifying machinery, also qualify for the exemption to the extent that that repair or replacement part has a useful life of more than a year. Other exemptions under the processing and manufacturing would be raw materials, and then again, packing materials. Those are deemed to be sold with your product, so you can purchase those for resale. Okay, another polling question.
All right, our third question, which of the following purchases may be eligible for the manufacturer's M&E exemption? Your options are A, hammer, B, HVAC system for the break room, C, safety goggles, or D, great pressure used in winemaking. And I will give everyone a few moments to respond. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Give everyone a few more seconds. And let's take a look at the results. Sarah, back to you.
All right, so hammer doesn't qualify a handheld tool unless it's some sort of power hammer. An HVAC system for the break room doesn't act or interact upon the product that you're manufacturing. Safety equipment, although I didn't mention that in the prior slide, does not qualify. So a grape crusher used in the winemaking process would be the equipment that would qualify for that M&E exemption. So one other tax that I wanted to briefly touch on today is real estate excise tax. Although Washington doesn't tax the sale or rental of real estate, they do impose real estate excise tax. So not only does a sale have its ordinary meaning, but it also includes the transfer or acquisition within a 12-month period of a controlling interest in an entity that has real property located in Washington. So for purposes of real estate excise tax, a controlling interest is either 50% or more of the total combined voting power of all classes of stock of a corporation, or 50% of the capital or profits, and same of a partnership with regard to the capital and profits. So now, that being said, there are some common exemptions from REITs. Gifts are generally not subject to REIT, so if you're gifting real estate, REIT generally does not apply. Where we get hung up here sometimes is that if there's any underlying debt with that real estate, the relief of that debt is considered to be consideration, and so you're no longer gifting something when you're relieving someone of debt. So that if there's underlying debt, the gifting exemption would not apply. Certain transactions between related parties, contributions or distributions of property, that sort of thing. Family entity transfers, so if you transfer to an entity that's wholly owned by the transferor or transferor's family members, you may qualify for an exemption there. And then another one is if there's no gain recognized under the IRC codes listed on this slide, you may also qualify for the exemption. So lastly, just to cover a couple of the current incentive programs in Washington, as I mentioned before, there's currently an exemption from the manufacturing B&O tax for the processing of fresh fruits, vegetables, dairy product, and seafood. That exemption is set to expire on July 1st, 2025, at which time an incentive rate would be provided for those activities. And I believe that rate is about a third of the normal manufacturing rate. This program has been extended a few times, so the July 1st, 2025 is a bit tentative. And another exemption would be the High Unemployment County Sales and Use Tax Deferral Program for manufacturing facilities. So what this is it's a deferral of sales tax associated with the construction and equipment purchases in new or expanding businesses. You have to be building, though, in a county that's determined to be a high unemployment county. The Department of Revenue updates that list quarterly. And then you have to apply for the deferral before obtaining a building permit or taking possession of machinery and equipment. It's called a deferral, but if you operate that facility in a qualifying manner for 8 years, then it's a permanent deferral and you will not owe any of the sales taxes associated. There's a new one that was passed in the legislative session last year that is for manufacturers. It's called the Manufacturers Eligible Investment Project. Again, it's building new facilities. This one, you can qualify for up to 2 projects. If you do 2, one has to be on the west side of the Cascades, one has to be on the east side of the Cascades. It's limited to the first $10 million of costs, and then taxes are repaid after 5 years on that one. So it's not a permanent deferral. Another one that's still in play is the sales tax remittance program for warehouses, distribution centers, and grain elevators. There's square footage requirements with each of those types of buildings. And this one, you pay the taxes up front, and then you file basically for a refund of only your state portion of the sales tax, so 6.5%. And then there's no pre-application requirement with this one. And there's also a B&O tax credit for new employees that are hired in manufacturing and R&D facilities or companies that are located in rural counties. And the credit there depends on if the employee is full-time or part-time. All right, I will turn it over to Colin to hit on Oregon.
Okay, thank you, Sarah. My name is Colin Quill, and despite what Wayfair said, I'm not dead. I'm alive and well. Oregon, unlike our neighbors to the north and the south, doesn't have a sales tax and doesn't have anything crazy like the business and occupation tax. But we do have a couple incentives that are available to food and ag businesses, and we just want to kind of cover that to round out our West Coast refresher. So I'll talk about 2 their property tax exemptions mostly, but they do have some other kind of aspects to them. The first one is the Oregon food processor property tax exemption. So food processors are able to get a 5-year property tax exemption on qualified machinery and equipment. And to qualify, the first thing you have to ask yourself is whether you're a food processor. There's really 2 components to that. There's the food component and, as you might guess, the processor component. So Oregon has defined what foods qualify and what processes qualify. So the foods that qualify are raw fresh fruit, vegetables, nuts, legumes, grains, bakery products, dairy products, eggs, or seafood. And this is a very strict list. So if you're processing anything else, you will not qualify. And the processes include freezing, canning, dehydrating, concentrating, preserving, processing, or repacking for human consumption. And again, those are very strict. So we have a lot of clients ask us about cold storage. And although you're buying machinery and equipment and you're keeping food cold, you're not actually processing the food, and so that equipment does not qualify. And so what does qualify is any newly acquired property, which means acquired within 24 months of putting into service, any property that is new or used, real, personal, or purchased or leased. So it's any equipment newly acquired. So you can purchase it a year ago and then place it into service today, and it would qualify. When the exemption was first promulgated, it didn't apply to bakers or dairy products, and that was recently expanded. And when the state give it, the state also take it away, and so they put a couple strings on the rules for the bakers. So for bakers, 90% of your total sales have to be by wholesale, and you have to have a wholesale license from the ODA. And the machinery and equipment involved have to have an initial investment of $100,000. The application process, no matter what kind of process you are, is fairly straightforward. So you have to apply for certification of the equipment by the end of February for equipment placed in service in the prior calendar year. You have to then request a site visit, and then after certification, you have to file an exemption claim with the DOR. So there's really just two agencies involved, and it gets kind of confusing. The timing of the claim is you have to make the exemption claim by March 1st, but no later than December 31st, provided you pay a late filing fee. And to give you an example of this, if you place property in service today, July 18th, 2018, it would begin to be exempt at the beginning of the property tax year on July 1st, 2019. So you would have to apply for certification by the end of February 2019 or later with a fee, and then you have to claim the exemption by March 1st or December 31st. The second incentive that's available for food and ag businesses is the Enterprise Zone program. So the Enterprise Zone program is an exemption from property taxes for businesses that locate or expand their operations within a designated enterprise zone. There are currently 69 E-zones, as we call them in the biz, in Oregon, and these are created and managed by local governments, also known as Enterprise Zone sponsors. And this can be sometimes a county or it can be a city. Sometimes those municipalities will hire a third party to kind of manage the program for them, but they are the ones that kind of designate the zone. And there's different types of enterprise zones and different incentives involved. The standard exemption is a 3-year property tax exemption. This can be extended to 5 years if the business meets certain employee wage requirements, which is it can be up to 150% of the county average. And this is not like a rolling average, kind of set. And so the department puts out chart that kind of gives you that number. Also, you can qualify for a construction in process or a CIP exemption for 2 years while the property is in construction. So altogether, under the standard E-zone program or the extended, you can get up to 7 years of exemption, which can be fairly significant. So how do you qualify? There's really 4 big requirements. One is to be located within an enterprise zone boundary. You have to be within an enumerated type of business, a qualified business. You have to make qualified investments, and you have to meet hiring requirements. And I'll talk about each one of these requirements individually. So first, you have to see whether you're actually located in the enterprise zone. And there are 69 zones. On this map here, there's a little tab to show you generally where the zones are. The blue tabs are the rural zones, and the red tabs are the urban zones. And we'll talk a little bit about why that matters here in a little bit. As you can see, it kind of follows the I-5 corridor and along most of the major highways. But the big thing to keep in mind is that just because, for example, you have a business in Eugene and there's a Eugene enterprise zone, doesn't mean it automatically qualifies. There's set boundaries within each city or within each county that has been kind of marked. And then as an example of that, we have the Portland enterprise zones, a map of that. So on the west side, there's just the Portland enterprise zone. On the east side, you have the East Portland enterprise zone. And it's really kind of scattered where this zone boundary is. And so looking at the map and making sure that your business or your planned expansion is within an actual boundary becomes very important. We've had clients that have been literally across the street from the zone, and unfortunately, they're not able to qualify. Next, once you know that you'll be in the zone, you have to be a qualified business. So a qualified business generally must be engaged in the business providing goods, products, or services to other businesses through its activities. There's a chart on the slide that kind of gives what qualifies and what doesn't qualify. So qualifying includes manufacturing, assembly, fabrication, processing, et cetera, et cetera. Also, that kind of stands out are call centers and headquarters. If you have a large company and you move your headquarters into Oregon, you might be eligible. And some zones allow for hotels and motels to qualify. On the flip side, non-qualifying then would be retail, childcare, housing, healthcare, construction, etc. And that brings us to our final poll question.
All right, our last question. Which of the following businesses may qualify for the Oregon E-Zone program? Your options are XYZ Accounting Services, Fabrication Specialist, Entertainment DJ Services, or a Busy Bee Daycare. Give everyone a few moments to make a selection, and once you have completed all CPE requirements, you will be able to download a PDF of your certificate from the certification widget to the right of the slide view. And let's take a look at the results. Colin, back to you.
All right, thank you. Looks like most people got it right. It is B, Fabrication Specialist. XYZ Accounting Services is a personal service that will not qualify. Entertainment DJ Services, although I wish it did qualify, does not because it's an entertainment business. And Busy Bee Daycare is a child care service. Fabrication is manufacturing, processing, etc., and would qualify. So you've got a qualified business, you're inside a zone, what's next? You have to actually make qualifying investments. And the biggest thing to know here is that land does not qualify. Newly constructed buildings and structures do qualify, as do additions or modifications to existing buildings and structures. And the way that the state kind of looks at that is whether there's been any increase to the square footage of the facility. So if you have a 2-story building, you build a 3rd story, that 3rd story would qualify for the exemption. Additionally, any heavy or fixed machinery and equipment, really any real property, machinery and equipment will qualify, and personal property greater than $50,000. Personal property that's greater than $1,000 but less than $50,000 may qualify if it produces tangible property, which is a big bonus. So again, on the flip side, things like land, supplies, motorized machinery and equipment, rolling stock, and any personal property that does not meet that $50,000 threshold or does not produce tangible property would not qualify. Additionally, the property must be newly purchased or transferred into the E-zone, so you can't just use your old machinery you got laying around. And the final requirement for the Enterprise Zone program is the hiring requirement. And you must increase full-time employment by the greater of 1 employee or 10%. So for a brand new business, it's 1 employee. If you have an existing business, it's 10% on what the average is in the last 12 months. There are exceptions. It differs by the zone, but the zone does offer these exceptions. Then they have to either have that $25 million threshold or demonstrate a 10% increase in productivity within an 18-month period. There are costs associated with the enterprise zone. It can be up to 1/10 of 1% of the estimated cost of the investment. Sometimes there's other requirements depending on the zone, so it's important that you check with the local sponsor. So the biggest thing to remember if you're considering the enterprise zone program is that you have to apply for authorization before the hiring or site work begins. So once you break ground, you're ineligible for the program. So just as long as you get the application in before you start, you're golden. And then after that, exemption claims must be made after January 1st, but before April 1st of each year of the exemption, so 3 to 5 years. And it cannot be any later than June 1st, and this is a very strict deadline. We've had clients that have submitted applications or exemption claims, June 5th, and they are not exempt. And this doesn't disqualify you for the entire period, just for that year. And so you can still file your exemption claim in the following year, provided that you're already authorized. The long-term rural enterprise zone is a special type of enterprise zone for those rural areas and zones. And what this does is it extends the exemption period to 7 to 15 years and expands the types of businesses that qualify. There's also an income tax credit associated with that. To qualify, there's a investment amount threshold, so it can be 0.51% of a county's total real market value. and there's a hiring requirement that's more stringent, and it all depends on where the zone is and where the business is. For example, the closer to I-5, there's different requirements. So you will have to look at where you are and what zone you're in. And then there also is the wage requirement, much like the Extended Enterprise Zone program. And we're at 1 hour now, and I'll pass it back to Emily to wrap it up.
Awesome. Thank you. We have run out of time for questions today. If you had a question for our presenters, you may still enter that in the Q&A window, or you can reach out to any of them directly, and we will follow up with you after the webcast. Thank you, Anna, Sarah, and Colin, for a great presentation today. We certainly had a lot of material to cover. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.